Okay, this week's market outlook. Starting with the summary. So, last week on Thursday, as I'm sure everyone is aware, Trump cancelled the strikes on Iran in the last minute and signalled that a deal between the US and Iran was on the horizon. Following this news, we saw on Friday Iranian state media say that an agreement with the US is largely finalised, but with no final conclusion yet. Followed by then the Iranian foreign minister saying that a deal to end the war has never been closer. So obviously this is like one of the first times in at least the last few months where we've actually seen a common ground between Iran and the US, them both actually agreeing that we're coming towards the end of a war. Um, and then fast forward to today, Pakistan's Prime Minister expects the US-Iran deal to be finalised within the next 24 hours. I think that's a bit optimistic. I don't think we're going to get it signed today. But yeah, we'll see. I believe JD Vance is in Pakistan right now. Islamabad, because that's what they're naming it, the Islamabad Agreement, I believe. So yeah, all eyes are going to be on that. So markets for the week ahead should definitely be pricing in some more optimism. Key events this week, obviously we'll go through them, but we have like 5 central bank rate decisions. We've got the Bank of Japan, RBA, Fed, Bank of England, and SNB. Personally, I think the market is going to be overlooking these to some extent, as optimism in the Middle East is going to lead to an unwind in short-end rates due to softer energy prices and obviously risk on flows. So yeah, that is essentially the summary for the week, the previous week and the week ahead. If we go into the calendar, we can see that for this week, we'll make it only red, yellow and red folder. Yeah, so for this week, Monday is very quiet. And then on the Tuesday, we've got the Bank of Japan with a consensus rate hike. I believe it's like 99% priced in by money markets for a 25 basis point rate hike. The RBA as well, that is a consensus rate hold. So yeah, those are the main events on the Tuesday. Come to Wednesday, we have inflation in the UK, which is forecasted to increase slightly, I believe, 20 basis points. Retail sales out of the US is expected to stay consistent. And then we obviously, in the evening, have the FOMC meeting, which is going to be very important, considering this is the first proper meeting that we have the new Fed chair in. So we're going to see how he's... What way is he tilting? Hawkish? Is he tilting more dovish? It's going to be quite important. So yeah, FOMC on the Wednesday, which is obviously a consensus rate hold. I don't know if I mentioned that. Thursday, we've got unemployment data out of the UK and Australia. We then have the SNB rate decision and the Bank of England rate decision. Both have consensus as a rate hold at the moment, with forward guidance being key, especially in the Bank of England. Then Friday, we have inflation out of Japan and then retail sales out of the UK, which have been hit quite hard. I mean, minus 1.3% was the last reading, which is not good at all. So yeah, that is the main events for the week ahead. Now let's get into the actual currencies. So starting off with the US dollar, the economic data that came out of the US last week showed CPI year on year breached the 4% handle, reinforcing the hawkish members of the Fed. The labour market is healthy, as we saw from the strong NFP print, and inflation is way above the Fed's target of 2 to 3%. And then now couple in yields remaining above the 4% threshold, the market is definitely going to be pricing in rate hikes, which is evident from the dot plot and short-end yields. This week's FOMC meeting is a consensus rate hold, as we've mentioned, and as you can see here from money markets, 99.5%. And it's also Kevin Walsh's first meeting, which will be pivotal in setting the tone. Optimism around the US and Iran potentially signing an agreement should see short-end yields drift lower among the whole of G8, to be honest, which in the short term may drag the dollar lower on a risk sentiment basis before continuing higher due to US economic resilience, because obviously, number one, the US is carry appeals decent, base rate of 3.75%, it's not bad at all, but now we're seeing yields start to fall, and optimism get priced in. We're going to see a lot of the carry trades actually unwind. So I do believe the dollar will probably start the week on a lower footing, and then FOMC will decipher whether we continue to go to the upside or downside. So yeah. But I do believe once we have this sort of correction, in the dollar from risk sentiment, driven by risk sentiment. I do think that the theme of US economic resilience will continue to drive the dollar higher. I don't think this is a dollar top just because we've had some optimism out of the Middle East. Regarding the institutions, they're pretty divided, which makes sense at the moment given the circumstances. I mean, if we just go over here to the insights, bear in mind a lot of these insights, like 13th of June, MUFG are now bearish on the dollar. Credit Agricole are bullish on the dollar. JP Morgan, bearish on the dollar short term. HSBC, Credit Agricole, short dollar CAD. So you can see it's super divided. There's not one clear narrative for this week with the dollar, unlike something like the pound, which we'll get onto now. So yeah, regarding the dollar this week, I'm more neutral. However, if I was to trade it, I'd be looking for, up into Wednesday, some dollar weakness, just from risk on flows and carry trades unwinding. Now the pound. So I'm bearish on the pound this week. As energy prices soften amid optimism in the Middle East, we should see short-end gilts retrace, coupling the fact that data out of the UK is extremely weak at the moment, evident from unemployment being at multi-year highs, inflation cooling, we're at like 2.8%, and sluggish GDP. It puts the UK in a weak place from an economic data and rate differential point of view. Not to mention this week, we have domestic political risks surrounding Andy Burnham, which could add more pressure on the pound. However, obviously, we'll have to monitor the UK 30-year gilt to see how the market interprets the decision. Regarding the data this week, CPI is obviously forecasted to bump up 20 basis points, I believe. However, markets are forward-looking, and the optimism around the Middle East is going to be way more of a driver of inflation expectations than the print, because I mean, I believe US oil is now at like a 3-month low. It's about to breach a 3-month low, which obviously kind of tells you the trajectory where the inflationary fears are going, which yields should start to follow. So yeah, that is basically where we're at on the pound, bearish on the pound. If we look at what the institutions are doing, we can see that, quite interestingly, MUFG have actually closed their GBP CHF position, which kind of tells you a lot about the pivot. They're kind of pivoting now from a long pound Swiss on a yield differential to now the actual opposite, shorting the pound and buying the Swiss on the now yields actually falling. I'll go over this when we talk about the Swiss franc, but look at how the MOVE index, which measures the volatility in bonds, correlates with gold and the Swiss franc, and that will tell you a lot. So yeah, MUFG bearish on the pound, obviously, or more cautious at least, because they've closed their pound Swiss position. Credit Agricole short on the pound. And who else? JP Morgan short on the pound, as you can see here. They long euro pound. And Bank of America, I believe. Oh no, they highlight political risks here. So yeah, I do think consensus among institutions is downside for the pound this week, and I agree, to be honest. So yeah, moving on to the euro. So the euro, I mean, I feel like we say this every week, but it's definitely neutral and dependent on the cross. I mean, the ECB last week was on the more hawkish side. However, that was overshadowed on Thursday when the Trump news came out, leading to short-end rates in Europe falling 3.5%, showing that the majority of the reason for why short-end rates were elevated in Europe was derived from geopolitical risk premium and, of course, elevated US oil prices, which the markets will now lead to a dovish repricing unwinding in the front end, as I've kind of mentioned from the softer oil prices, as we see optimism and risk on flows be the main driver of the market for the near term. So I'm happy taking longs on euro pound. Not right now. I'll show you the levels I'm looking at when we get into the technicals, and euro CAD, whilst shorting euro AUD and euro NZD. So yeah, that's what I'm looking at on the euro. Onto the CAD. So we are bearish on the CAD, as I'm sure many of you are aware. Softer US oil prices, a dovish tilting Bank of Canada, and a neutral to weak data should limit CAD strength in the near term. Short-end rate differentials have been drifting lower, and that trajectory should continue unless we get some unexpected news surrounding the Middle East. I still believe that dollar CAD upside makes sense. MUFG and JP Morgan are both fans of shorting the CAD, and we agree. Personally, I'll be expressing this view through AUD CAD upside and NZD CAD upside, as it's also a sort of commodity currency and high beta hedge. Obviously, by high beta hedge, I mean this equity push we're getting from not just SpaceX but also sentiment is now going to propel these higher risk currencies to the upside. So yeah, that is what I'm looking at there. If we look at what the institutions are saying specifically, MUFG, yeah, they're shorting G10 commodity currencies, so like the CAD. Who else was it? JP Morgan, I believe. Yeah, short positions, CAD. So yeah, that is where I am on the CAD at the moment. Bearish. Moving on to the Australian dollar. So I am bullish on the Australian dollar this week. I do think we should see a bounce in the AUD. Short-end yields have not benefited the Australian dollar as of late, but the trajectory for the RBA is still clearly to the upside. Even with softer inflation data, the trend is overwhelmingly clear. Equities bouncing from sentiment and the massive demand from the SpaceX IPO on Friday should support higher beta currencies. I also noticed a decent inflow into the Chinese yuan following Thursday's announcement, which should support China proxies in the near term. Also from a commodity currency point of view, softer global yields derived from these Middle East optimism. Copper, gold, silver should all move higher, which obviously benefits Australia. MUFG, Credit Agricole, JP Morgan and Goldman Sachs are all in agreement of upside in the AUD. So if we look at the insights, MUFG, long positions in the Australian dollar. Credit Agricole, long positions AUD USD. Who else was there? JP Morgan, AUD upside, and Goldman Sachs. AUD and NZD upside. We'll go into the NZD now. But yeah, bullish on the Australian dollar. Now, similar story with the New Zealand dollar. I mean, it performs amazingly in these environments where we receive softer energy prices and risk on flows, coupling the China flows. So, I mean, definitely positioned for upside. Equities rebounding from sentiment, but also the SpaceX IPO showing massive inflows from funds into equities. You can look at CTA data for that as well. And then coupling the stronger Chinese yuan, as mentioned, following a softer dollar and stronger commodities, should push the New Zealand dollar higher. Which is why I think this week GN, EN, NU and NJ are all great plays. And then as we just saw there, institutionally, Goldman Sachs are a big fan of New Zealand dollar upside. So yeah, that's where I'm at there. Japanese yen, we are bearish, as we have been. We'll talk about the Bank of Japan rate hike and why I think that's going to not do too much for the yen. But, I mean, domestically, things continue to point to the downside in Japan. This week's Bank of Japan meeting is a consensus hike, priced in around 99%, meaning that the rate hike itself is unlikely to provide the yen with massive strength. The post-meeting forward guidance is going to have to be extremely hawkish, in my opinion, for it to have any long-lasting impact on the yen, which is why my base case, as it stands, is to fade any yen strength. I mean, institutionally, essentially everyone is bearish on the yen. Credit Agricole, HSBC, JP Morgan, those are just naming a few. You can look in the Insights tab and you can basically see that the majority of institutions are bearish on the yen and have been for the last God knows how many months. So, the Swiss franc. Well, apart from the SNB's guidance this week being key, I do believe the Swiss franc should catch a bid, purely based off cooling global yields as mentioned, resulting in institutions unwinding some of their carry plays, such as GBP Swiss franc, which MUFG actually closed last week. Which kind of, it tells you how the institutions are positioning for the week ahead, and they kind of think this Middle East tensions and the current upside in higher yielding currencies is going to take a bit of a breather. This should also support gold bleeding into the Swiss franc. The correlation between the MOV index and gold, as I mentioned, is quite clear. And institutionally, Credit Agricole and Goldman Sachs are both bullish, with risks of the SNB being more hawkish this week. So, Credit Agricole who was it? It was, Credit Agricole. Well, Goldman Sachs here, you can see that they expect the Swiss National Bank Risks tilted towards future hikes. So a hawkish SMB is what Goldman Sachs are kind of forecasting. So yeah, that is essentially the macro analysis this week on the currencies. Now let's get into the actual technicals. So starting with the dollar, as mentioned, I think this level here, the 99.5, is going to be great for longs, but at the moment, I do think risk sentiment off the open is going to push the dollar lower. This level here is quite nice, the 99.75, 99.8. I'd definitely be looking for downside here. Definitely a more risky play. There's a lot more clearer opportunities in the market at the moment, but it's definitely one on the cards. Dollar yen, I'm kind of leaving it. The price action, I mean, you can get like destroyed here just from intervention. Obviously, this Thursday move here was all driven by Trump's announcement, but we're above the 160, so it's going to be, you're playing a very risky game. I'll say that. Dollar Swiss, I kind of want something like this to happen. I believe we've taken out a lot of the highs following Trump's announcement on Thursday. And so what makes sense is we'll probably come down, have a slight bounce off this level, retracement back up, and then we'll continue to the downs to the 7-9 handle probably. So yeah, that's what I'm looking at there. Dollar CAD, I still believe upside will prevail. I think this level was nice to get in at, which you could have gotten on Friday. However, this level is much nicer, below the 1395. NZD USD, I'm looking for upside. To be honest, I'm probably expecting a gap up on the open, come back down into the gap, and then go. Similar thesis with NZD CAD, to be honest. However, this level here is quite nice. If we come back down into here, I might take a long. GBP NZD, obviously we're looking for shorts, but let me move that there. I think this level here, I mean, we're going to see a lot of bounces because these algos perform extremely well in these environments. But I think something like this could be realistic. GBP Swiss caught a nice 1-to-1 on the Friday on this, based off de-escalation, of course. I think we're going to see downside from here. I think we could probably come down here. So yeah, that's what I'm looking at there. But also bear in mind, we've just taken out monthly highs and we're in a very nice demand zone. So I do think downside makes sense. GA, exact same thesis as GN. CAD Swiss, I like downside from this level here. Pretty simple. AUD dollar, I think this level is going to hold. Well, we've got a reaction off this level. Now, we're looking for upside, of course. So I think maybe something like this. Somewhere in this region here. If we do, because I do believe, as mentioned, bounce up into this level, then we'll go. That's what I'm looking for. It's definitely more risky, as we're clearly going against a trend here. But why? It's because the macro thesis, in my opinion, has pivoted. So it makes sense. AUD CAD, I like this here, targeting London session highs and even weekly highs up here. NJ, be careful. Obviously, it's the yen, but I think this demand level here is clearly being respected. So I wouldn't be surprised if we come back down, maybe into this level on Thursday, and we go. Euro pound. So I believe I mentioned I'm being a bit careful on euro pound. So obviously, I think macro-wise, rate differentials are going to end up favouring Europe over the UK. I think the data at the moment is favouring Europe over the UK. We've gone over the fundamentals. However, technicals on this pair are not the nicest for upside. So I think we're going to take out the monthly low. We'll get a reaction from here. And then kind of data this week will kind of tell us where we go from here. So yeah, I'm looking for something like this. Then finally, Swiss franc against the yen. I think this demand zone here is perfect. Could even target a 1 to 2. Yeah, I think this looks quite nice. I mean, we've taken out a lot of liquidity on this pair from the Swiss franc weakness, which we haven't had. I mean, if you actually zoom out and look at the Swiss franc, I mean, the Swiss franc has been so strong for so long. So this kind of spike in global yields has allowed for a lot of investors to take profits. but also rebuild positions longer term. So I think this here makes a lot of sense, and I believe that's everything. Yeah. So gold as well. Actually, I'm not sure. We went over this. Yeah. So I think this is a nice level for gold here. Take out these London lows, and then we go for a 1 to 2, something like that. So yeah, that is the technicals for the week ahead. Yeah, pivot in a big pivot in the fundamentals, which is obviously reflected in the technicals as we're now kind of trying to buy up from these lows. But yeah, as always, drop a like, drop a comment, and we'll catch you in the next Outlook.